If you had just $1,000 right now, would you risk it all on a single crypto coin? Put it in a high-interest savings account and let it sit. Or would you scroll endlessly through Reddit and YouTube, hoping someone else has the answer? The truth is, most people have no clue what to do with their first $1,000, and in 2025, that confusion is worse than ever. Between AI-powered trading apps, influencer hype, and an economy that's constantly shifting, it's easy to feel stuck. But the surprising part, the best strategy isn't the flashiest one. It's slow, steady, and surprisingly simple. Before we dive into the topic, just hit subscribe to Financially Well so you never miss strategies that actually build wealth, especially when you're starting with just a little money. Let's start with one basic truth. Investing your first $1,000 isn't about doubling it in a week. It's about building habits that could one day turn thousands into millions. So, the first step? Split the money. Don't dump it all into one asset. That's the rookie mistake. Instead, think in percentages. Think protection, growth, and optionality. First, take $500, or 50%, and put it into a diversified index fund. Why? Because in 2026, volatility will still rule the markets. One day tech stocks are flying, the next they're crashing. Index funds smooth out the chaos. Whether it's a fund that tracks the S&P 500 or a broader global ETF like VT, this move instantly makes you a shareholder in hundreds or even thousands of companies. It's passive, it's proven, and it's smart. And the fees? They're almost non-existent, especially if you go with brokers like Fidelity or Vanguard. Even robo-advisors like Wealthfront or Betterment can automate this for you for less than 0.25% annually. That's basically pennies for peace of mind. But now comes the part most beginners ignore: cash reserves. From your $1,000, take $200 and keep it in a high-yield savings account or a money market fund. It sounds boring, but here's the logic. Emergencies happen. If your car breaks down or you get hit with a surprise expense and all your money is locked up in investments, you'll either go into debt or sell at the worst time. That cash buffer isn't just a cushion. It's what allows your investments to grow undisturbed. In 2025, with interest rates still elevated compared to past years, some online savings accounts offer up to 4.5% APY. That's actually decent for holding cash, and you can access it whenever you need it. So, now we've used up $700 of your total. That's where things get interesting. Take $200 and put it toward learning and exposure, not just returns. This could mean buying fractional shares in individual companies you believe in. Maybe it's Tesla, Apple, Nvidia, or even something riskier like emerging market tech. But here's the key: don't invest in companies. It forces you to follow the news, understand earnings, and pay attention to global shifts. You're not just buying stock, you're buying perspective. Even if you lose, the lesson is worth it. That leaves $100. What do you do with that? Here's the twist: use it to invest in yourself. Most people think investing only means stocks and bonds. But the highest ROI often comes from a new skill, a course, a tool, or an idea that improves your earning power. Maybe it's a $79 course on Excel, Notion, or Python. Maybe it's paying for a premium subscription to a finance tool that helps you budget better. Maybe it's even launching your first online side hustle, buying a domain name, setting up a site, or testing out a small ad. That $100 might not turn into profit overnight, but it could spark something that compounds for years. Now here's what most beginners get wrong. They obsess over perfect timing. Should I wait for the market to crash? Is AI going to make everything obsolete? The truth is, time in the market beats timing the market. If you're sitting on $1,000 waiting for a perfect moment, inflation is quietly eating away at your buying power. The longer you wait, the harder it becomes. Investing is like planting a tree. The best time was 10 years ago. The second best time is right now. And don't forget taxes. It's not exciting, but it's real. If you're using a taxable brokerage account, any gains you make can be hit with capital gains taxes. So, if you're thinking long-term, consider opening a Roth IRA if you qualify. In 2026, the income limits are still manageable for most beginners, and whatever you earn in that account can grow tax-free. That's right, no taxes when you withdraw in retirement. Imagine turning that $1,000 into $50,000 over decades and not giving a dime of it to the IRS. That's the kind of hack most people overlook. Now you might ask, what if I live outside the US? Good news. Many of these principles still apply. Whether you're in Europe, Asia, or anywhere else, local index funds, cash buffers, fractional investing, and self-education are universally smart. The platforms might differ, the tax rules will change, but the fundamentals remain. Invest broadly, stay liquid, and learn fast. Also, don't underestimate the power of automation. In 2026, there's no excuse not to automate your contributions. Set it and forget it. Whether it's $10 a week or $50 a month, consistency builds wealth. Most people fail not because they don't know where to invest, but because they don't invest often enough. Automation removes emotion. You don't panic sell when the market dips. You don't overthink when it spikes. You just keep going. Here's another twist to consider. Invest with a goal. Don't just say, "I want to be rich." And yes, risk is real. Crypto could crash. Markets could fall. AI might replace jobs. But here's what's even riskier: doing nothing, sitting on cash that loses value, watching TikToks about success instead of building your own. Everyone wants the fast route, but wealth is quiet. It's built in the background. While others are chasing trends, you're stacking assets. And remember, the goal isn't to be perfect, it's to be consistent. Mistakes will happen. Maybe you'll buy the wrong stock. Maybe the fund you picked underperforms. That's fine. Learn, adjust, move on. One $1,000 investment isn't going to make or break you. But the habit of investing every month? That will. Also, stay curious. Read books. Follow credible finance creators. Avoid hype. Ask questions. In 2026, AI-generated nonsense floods your feed every day. But the timeless truths still win. Diversify, stay patient, avoid debt, grow skills, keep learning. If you follow this simple breakdown, $500 in index funds, $200 in cash, $200 in exploratory stocks, and $100 in yourself, you're not just investing money. You're building a foundation, a mindset, a lifelong strategy. And the best part? Anyone can do this. You don't need a finance degree. You don't need $1 million. You just need to start. So now the question is, will you actually take action? Or will you wait for someday? Because that someday never comes unless you make it today. If this gave you a clear roadmap to start investing, don't forget to subscribe to Financially Well so you never miss these step-by-step strategies designed to build your wealth from the ground up.